Hi there, it's Friday the 31st of January 2020. I'm Steve Towers. Welcome to ITB. Let's get started. As you know, the last ITB video was on the 17th of January, which was 2 weeks ago. There are a number of important stories which emerged during the first week. I've included those stories in today's video, but to distinguish them from this week's stories, they're marked as catch-up stories. As I'm sure you know, a truce has been agreed in France's dispute with the US over its 3% digital services tax. France has agreed to delay collection of the tax until December 2020, and the US has agreed to not impose additional customs duty of up to 100% on certain imports from France. Also, the two countries have agreed to work together to achieve a long-term global solution. And now the US has turned its attention to other European countries with DSTs. Treasury Secretary Mnuchin said that the US will impose customs duties on imports from Italy and the UK if they proceed with their DSTs. Italy has already enacted its 3% DST, but the tax payments don't start until 2021. The UK plans to enact its 2% DST with effect from the 1st of April 2020, a point which was confirmed last week by UK government ministers. Also, the US government has filed an official protest with the Czech Republic in regard to its proposed 7% DST. The DST bill is currently in the Czech Parliament. And more European countries are showing an interest in introducing a DST. In the last week, it's been reported that Latvia has commissioned a study on possibly introducing a DST. And in Denmark, the government has stated that it has changed its position. It will now support an EU-wide DST if a global solution is not agreed. The inclusive framework met behind closed doors on Wednesday and Thursday of this week to discuss Pillars 1 and 2. The plan is for an update to be delivered to the G20 finance ministers at their meeting in Riyadh on the 22nd and 23rd of February. As of right now, no reliable information has been released or leaked on the outcomes of this week's meeting. But I expect that the OECD will give us a good summary of the meeting in the next OECD Tax Talks webcast, which is scheduled for today, the 31st of January, at 2 p.m. Paris time. If you can't attend the live webcast, an on-demand option is available. To register for the webcast, please go to our website or app. However, no doubt, one of the major topics for discussion at this week's meeting was the US proposal for Pillar 1 to be a safe harbour regime, which a German government official recently described as a slap in the face. Also, French Finance Minister Le Maire caused some confusion when he announced, as part of the France-US truce over the DST, that the US has agreed to drop the proposal to make Pillar 1 optional for companies. However, a US government official has clarified that the US position has not changed. It's merely terminology. The US does not like optional. It prefers safe harbour. In the lead up to this week's Inclusive Framework meeting, a number of documents have been posted on the International Centre for Tax and Development website, reflecting the position of developing countries generally and African countries in particular. Here are 3 documents which are worth noting. For copies of these documents, please go to our website or app. As you might know, the WTO's appellate body, which hears appeals from dispute settlement panels, is currently inoperative due to the US vetoing new appointments to the body. 17 members of the WTO have responded by agreeing to form their own private appeal settlement arrangement. This so-called multi-party interim appeal settlement arrangement is in accordance with the WTO rules. For a copy of the statement made by the 17 members, please go to our website or app. In Australia, the tax authorities have issued a taxpayer alert on cross-border arrangements in regard to intangibles. The alert states that the tax authorities are closely scrutinising these arrangements. They are concerned that the arrangements do not satisfy the arm's length principle, fail to recognise the disposal of Australian assets, and/or were entered into for the sole or dominant purpose of reducing Australian tax. The alert describes 2 types of arrangement which share a common element. Australian DEMPI activities in connection with intangibles are not properly recognised and remunerated. For a copy of the alert, please go to our website or app. In India, the Mumbai Income Tax Appellate Tribunal has decided a case in regard to Article 12, the Royalties and Fees for Technical Services article in the India-Sweden Treaty. You'll remember that in ITB on the 17th of January, I discussed a similar case, Kelly Services, which was decided by a differently constituted bench of the Mumbai Tribunal. Based on the facts, the tribunal reached a different conclusion in this case. In the India-Sweden Treaty, the definition of fees for technical services has been effectively narrowed by the triggering of a most favoured nation provision. It now effectively reads as follows. The term fees for technical services means payments of any kind in consideration of the rendering of any technical or consultancy services, if such services A are ancillary and subsidiary to the application or enjoyment of the right, property or information for which a payment which satisfies the definition of royalties is received. The key issue in the case was the application of the ancillary and subsidiary condition in paragraph A. Here are the facts. An Indian company entered into 3 agreements with a Swedish company: a trademark license agreement, a technology license agreement, and an IT services delivery agreement, with fees to be paid under each of the agreements. It was accepted that the fees paid under the trademark license agreement and the technology license agreement were royalties under the Article 12 definition. However, the taxpayer argued that the fees paid under the IT services delivery agreement did not fall within the definition of fees for technical services due to the ancillary and subsidiary condition. The tribunal rejected that argument. It said that the 3 agreements are meant to function together and the royalty agreements cannot be effectively implemented unless they are integrated with the IT support agreement. For a copy of this case, please go to our website or app. And also in India, the government will present its 2020 budget tomorrow. I'll tell you all about it next week. In the Philippines, the Securities and Exchange Commission has issued revised regulations in regard to REITs. For a copy of the revised regulations and also a copy of a press release on this topic issued by the Department of Finance, please go to our website or app. In Taiwan, the customs authorities have issued guidance on the customs duty impact of so-called one-time transfer pricing adjustments. You'll remember that the Ministry of Finance issued transfer pricing guidance on one-time transfer pricing adjustments in November 2019. For a copy of this latest guidance from the customs authorities, please go to our website or app. In Thailand, the government has released for public comment a third draft of proposed VAT regulations which would impose VAT on inbound B2C digital services. But the government's short period for public comment has now closed. But you can still obtain a copy of the draft. Please go to our website or app. In Austria, the government has stated that the proposed reduction in the corporate income tax rate from 25% to 21% will be made in 2023 or 2024. In Denmark, the National Tax Tribunal has decided a transfer pricing case in regard to a business restructuring. Here are the facts. A German parent company was the legal owner of IP in regard to an engine design. It entered into an arrangement with its Danish subsidiary in regard to the commercial exploitation of the IP. That arrangement was a so-called 50-50 royalty split agreement, under which the Danish subsidiary would perform oversight and support functions in regard to the third-party licensing of the IP, and the two companies would share the gross royalty income 50-50. During the period of this arrangement, the Danish subsidiary substantially enhanced the engine design. At a later time, the two companies agreed to immediately terminate the 50-50 royalty split agreement. As part of the termination, the German parent agreed to pay a lump sum compensation payment to the Danish subsidiary. This compensation payment was calculated as the present value of the Danish subsidiary's projected net profits from the arrangement for the next 2 years. According to the group's transfer pricing documentation, the 2 years was selected by identifying termination notice periods in comparable situations involving third parties, and is therefore in accordance with the arm's length principle. The tax authorities determined that the 2-year period was insufficient on the basis that it did not take into account the valuable enhancements which the Danish subsidiary had made to the engine design. It therefore recomputed the lump sum compensation payment using a longer period, which unfortunately is not specified in the tribunal's decision. And the tribunal agreed with the tax authorities. An interesting aspect of this case is that the Danish subsidiary was converted into a branch, a PE, of the German parent during the course of the 50-50 royalty split agreement. So therefore, strictly speaking, this is an Article 7 case, not Article 9. And Article 7 of the Denmark-Germany Treaty, which entered into force in 1996, is in effectively the same form as in the 2008 OECD model. But that issue did not stop the tribunal from applying the 2017 OECD transfer pricing guidelines. For a copy of this case, please go to our website or app. In the European Court of Justice, the Santander case concerning the EU's state aid treatment of Spain's goodwill amortisation scheme has come to a halt. The ECJ has decided that the reference from Spain's Central Tax Tribunal is invalid because the tribunal lacks the required independence from the Spanish government to be a court or tribunal within the meaning of Article 267 of the Treaty on the Functioning of the European Union. You'll remember that Advocate General Hogan issued an opinion to this effect last year. For a copy of the ECJ's decision, please go to our website or app. The ECJ has also decided a case in regard to the refund of Dutch dividend withholding tax to a fund established in Germany. The case concerns the free movement of capital in Article 63 of the Treaty on the Functioning of the European Union. A collective investment fund which was established in Germany owned shares in a number of Dutch companies. All of the shareholdings were less than 10%. The Dutch companies paid dividends on those shares and deducted 15% dividend withholding tax in accordance with Dutch tax law and the Germany-Netherlands Treaty. Under the Dutch tax law, a collective investment fund can obtain an exemption from the dividend withholding tax if it qualifies as a fiscal investment enterprise, an FIE. Importantly, both resident and non-resident funds can qualify as FIEs, and the conditions for such qualification are the same for both resident and non-resident funds. Under prior case law of the ECJ, qualification conditions can be held to be discriminatory even though the same conditions apply to both resident and non-resident funds, if, in a de facto sense, it is significantly easier for resident funds to satisfy the conditions. That was the situation in the present case. One of the conditions for qualification as an FIE is that the fund makes a full profit distribution to its shareholders or participants within 8 months of its year end. Under Dutch tax law, such a requirement has the effect that the shareholders or participants are taxable on the fund's profits on a timely basis. However, under the German tax law, taxation of a fund's profits at the level of the shareholders or participants is achieved by a deemed full profit distribution. An actual profit distribution is not required. The ECJ said that it needs to be determined whether the objective of this particular condition is to achieve taxability at the shareholder participant level on a timely basis. It asks the referring Dutch court to determine that issue. On the assumption that that is indeed the objective, the ECJ held that the condition, when applied to the German fund, is a de facto discrimination and thus a breach of the free movement of capital. For a copy of this case, please go to our website or app. It looks like the next flashpoint in global trade might be in regard to the EU's possible carbon border tax. At the World Economic Forum in Davos, European Commission President von der Leyen gave a keynote speech which ruffled some feathers in Washington. She said this: "But there is no point in only reducing greenhouse gas emissions at home if we increase the import of CO2 from abroad. It is not only a climate issue, it is also an issue of fairness. It is a matter of fairness towards our businesses and our workers. We will protect them from unfair competition. One way for doing so is the Carbon Border Adjustment Mechanism. But I prefer to encourage our trading partners to work with us for a global level playing field for the benefit of all of us. California, for instance, is showing the way with an emission trading system that covers 85% of CO2 emissions. I also commend China for taking the first steps towards a CO2 pricing system. These may only be the first steps towards a level playing field, but if this turns into a global trend, we will have a global level playing field where no carbon border tax will be necessary. This is an example of the new modern international frameworks we need. This shows that if you engage with Europe, you will find a reliable partner working for a more sustainable world. But we ask for fairness in return. We have a lot to offer. We are the largest single market in the world. We are one of the 3 largest economies. We are the largest source and destination of foreign direct investment. We have more than 80 free trade agreements and over 700 international economic agreements. All these agreements are not just about trade. They are platforms to shape and harness globalization, and they are drivers to build common solutions to challenges such as climate change. As you can see, her comments provide a mixture of carrot and stick. The response from the US was swift. Treasury Secretary Mnuchin described a carbon tax as a tax on hard-working people. And Commerce Secretary Wilbur Ross said this: depending on what form the carbon tax takes, we will react to it. But if it is in its essence protectionist, like the digital taxes, we will react. For a copy of President von der Leyen's speech, please go to our website or app. The European Commission has concluded that a German provision in regard to the carry forward of tax losses does not constitute EU state aid. The provision allows a so-called ailing company to offset losses against profits in future years, despite changes in its shareholder structure. The Commission's decision was announced in its daily news bulletin on the 22nd of January. For a copy, please go to our website or app. As I'm sure you know, the UK will leave the EU at 11 p.m. GMT tonight, but there will be very limited immediate impact. A transition period will run from tomorrow, the 1st of February, to the 31st of December 2020. During those 11 months, the UK will effectively remain in the EU's single market and customs union. And importantly, discussions on the long-term EU-UK trade relationship can begin. In the UK, the High Court has decided an interesting VAT case, which could ultimately cost the UK revenue tens or even hundreds of millions of pounds. The case concerns managed litigation involving 340 claimants in regard to services performed by Royal Mail. For many years, it was assumed that those services are exempt from VAT. Based on that assumption, Royal Mail did not issue VAT invoices to its customers. However, a European Court of Justice decision in 2009 indicated that the VAT exemption for postal services applies only to universal postal services, whereas individually negotiated services are taxable. The claimants in the managed litigation are claiming that Royal Mail was and is obligated to provide them with VAT invoices, which would enable the claimants to obtain input tax credits from the UK revenue authorities for a period spanning several decades, even though no VAT had been charged. This recent High Court case addresses a number of preliminary issues in the managed litigation. For a copy of the court's decision, please go to our website or app. And also in the UK, the tax authorities have claimed that an extra £5 billion of tax has been collected from multinationals by virtue of the diverted profits tax. Interestingly, a large part of this additional tax is not in the form of DPT itself. Instead, the tax authorities claim that the DPT caused changes in behaviour which increased corporation tax receipts. For a copy of the tax authorities' press release on this matter, please go to our website or app. In Zimbabwe, the tax authorities have issued a public notice which requires businesses to pay their Zimbabwean tax liabilities in foreign currencies, to the extent they engage in transactions in foreign currencies. This requirement applies prospectively to income tax, VAT, payroll withholding tax, and capital gains tax, and it applies retrospectively from the 22nd of February 2019 to mining royalties. In Bahrain, the Ministry of Industry, Commerce and Tourism has issued guidance on the economic substance requirements for non-regulated commercial activities. Similar guidance has been issued by the central bank for regulated financial activities. In Oman, the government has confirmed that VAT will be introduced sometime during the beginning of 2021. In Argentina, the government has published a resolution which suspends the review and processing of applications under the so-called knowledge economy regime. For a copy of the resolution, please go to our website or app. In Chile, the amended tax reform bill has been passed by Congress. After review by the Constitutional Court, it will then be ready for the President's signature. In the US, Treasury and the IRS have issued final regulations on transfers of appreciated property by US persons to partnerships with foreign partners which are related to the transferor. The final regulations substantially follow the expired temporary regulations on the same topic. For a copy of the final regs, please go to our website or app. And now for this week's treaty developments. We've had 2 treaties signed, 4 treaties enter into force, 1 protocol enter into force, and 1 mutual agreement signed. I have 2 articles for you this week. The first article is called European Union Final Losses in Respect of Cross-Border Mergers, Mamira Case and Holman Case. It's written by Harm Vandenbroek and it's published in the IBFD's European Taxation Journal. As the title indicates, this article examines the decisions of the European Court of Justice in June 2019 in the Mamira and Holman cases. Those cases address whether a cross-border merger in the Mamira case and a proposed liquidation in the Holman case result in so-called final losses, which, on the basis of the landmark Marks and Spencer case, could be transferred to a parent company in another EU member state. The second article is called "Is Guilty Operating as Congress Intended?" It's written by George Callis and Mark Prater, and it's published in Tax Notes Today International. One of the interesting comments in this article concerns the strong possibility that guilty will be the model for the income inclusion rule under Pillar 2 of the Inclusive Frameworks Digitalisation Project. The authors write this: in a related and rapidly progressing development, the OECD is revisiting long-standing rules and norms of international taxation. Some of the discussions have focused on whether to propose a guilty-inspired set of rules on a country-by-country or entity-by-entity basis. The guilty drafters decided that an entity-by-entity approach would be too onerous, and a country-by-country approach would be even more so, for example, because of the check-the-box rules, and thus would caution US negotiators against signing on to a proposal that rejects one of Congress's clearly preferred design features. Well, that's the way it is this Friday, the 31st of January 2020. I'm Steve Towers. Have a great weekend.